All right. Hi, everybody. Thanks for joining us. So today, Adrian and I are going to discuss the latest autumn statement from Jeremy Hunt, which was interesting. Frankly, it was the first either budget or statement or mini budget or whatever you want to call it these days. They keep changing the names. Frankly, the first one in a while that actually had, well, I was going to say it actually announced things, but then Kwasi Kwarteng announced a lot of things, but they all got repealed. So it's interesting, and I think it's just, what is interesting about this is the 180 sort of going from cutting taxes to raising taxes in general, but B, it's also because when Sunak was Chancellor under Boris, Sunak had committed to having lower taxes by the end of the premiership. Now, that doesn't look like it's going to happen either. Again, interesting. We're going to unpack a number of the different announcements and give our views on it. But Adrian, why don't you kick off? So what was your overriding sort of thoughts around the autumn statement?
Yes, so Adam, as you said, it was 180s or, U-turns are getting thrown around a lot in the political dialogue at the moment, but we did effectively see £100 billion shift from Kwasi Kwarteng's budget to this statement, which is obviously a big number in terms of the finances. So that's got to come from somewhere. That's unfortunately got to come out of people's pockets. My overriding impression with a lot of these budgets is that I get a bit frustrated with the fiddling that goes on rather than the tinkering and rather than the sort of, I think there's not a lot of opportunities to simplify things and actually potentially get better results, but that's somewhat philosophical, so we might move on from that. But one of the terms that's been thrown around, fiscal drag, or there's a number of names for it, bracket creep is what we used to call it back in Australia. And I remember way back in 1987, Paul Keating, who was the former Australian Prime Minister and at the time Treasurer, which is effectively the same role as the Chancellor, declaring he'd balanced the budget, and he did that in those days using, there was times of higher inflation, and he used bracket creep effectively to do that, where people were earning more, prices were going up, but we kept the rates of tax the same, and the levels at which you move from one bracket to the next meant that the overall take to the Treasury was increasing. So he very cleverly came up with that a long time ago, and he probably wasn't the first. So
it was the Lizard of Oz. Remember when they had the photo of him with his hand on the Queen's back, and the Sun, I think, called him the Lizard of Oz.
Yeah, that sounds about right. He was, and still is, quite an interesting character. But so to the here and now, there was a bit of sort of unpicking where we had this funny scenario where Kwasi Kwarteng, one of the former chancellors, announced a whole lot of stuff. But then when Jeremy Hunt was appointed, he announced that he was cancelling a whole lot of stuff. And then, and in the first place, Kwasi reversed things that Rishi Sunak, another former chancellor, had put in place. So there is a little bit of unpicking around this to get to what the actual situation is going to be going forward. Company tax is the one that jumps out of that, because there was nothing really announced on company tax. Yeah. So we are getting the increase that Sunak originally put in place when he was Chancellor, that Kwasi reversed, that Hunt's reversed, which meant he didn't need to mention it in the statement. So
well, I think everyone missed
good
it.
fun keeping up with that.
Yeah, well, I think you raise a really good point, because frankly, I think everyone in the press, and me included, in terms of when I put out this note, I missed this because there was no announcement about company tax or corporation tax. And frankly, I was waiting for an announcement and there was nothing. So my conclusion on that was, okay, well, it stays as it is. But then what is his situation that it stays as?
Yeah, so from April next year, for companies that turn over more than £250,000, the company tax rate goes up to 25%, rather than the current 19%. And it's actually, there is some nuance in that. There's a bit of some of those rates depending on how long you're in one bracket and how long you're other, and all that sort of stuff for companies that have year ends over that period. So the company tax is going up. It's not for the smallest companies, but for anyone who's in a business turning over 250,000 or more, yes, 25% becomes the rate, for better or for worse.
So before we start going through the other individual segments, I think my overarching thoughts around this was that there is a distinct trend and a distinct theme through this budget, or through the autumn statement budget, call it all the same thing, that frankly is, and I think I mentioned this in my notes, but this is they've certainly focused the tax on capital and not labor, and they've made a clear distinction. Being if they, labor, they've somewhat tried to protect labor. And again, thinking back to something that was repealed, they kept the repeal, was the national insurance reduction. So the reduction in national insurance from the previous increase in national insurance. So national insurance went up for a while, Kwasi-Kwarteng repealed it, and they've kept that repealing in. So therefore, national insurance is not going back up. Again, the focus is reducing taxes on labor, but on the capital side, and again, we'll talk about this, it's the idea of this sort of creeping, we're not going to put the tax rates up, but we're just going to reduce the allowances on all manner of things. And also, I mean, with the one exception being on the labor side being the additional rate tax threshold, but again, they're focusing it very much on the highest earners, which is very much theme of this Conservative government over the past 12, it must be what, 12 years now, where they are very much, the philosophy is the tax the rich philosophy is there, and they continue to sort of squeeze the highest earners in society in all manner of ways. So
yes. Well, they had George Osborne in advising Jeremy Hunt, didn't they? So we're almost back to, I don't think they ever call it Osborne economics, but yeah, George Osborne was snuck into the briefings for Jeremy Hunt and so forth. So
as a special advisor, was he being paid by BlackRock to be in there, or was he paid by the London Museum to be in there, or was he even standard? I mean, there's a man of many paychecks, shall we say?
He did the mandatory sort of smirk as he was, photographed going in to speak to the Treasury advisors anyway. So his fingerprints are on this a little bit as well, and it is very much in line with the themes that we had all those years ago when he was one of our chancellors. But
let's start with the idea of this. All right. So the main, one of the big headlines was the decrease in the rate, in the level of earnings where the additional rate threshold, so i.e. the 45% kicks in. So that was 150,000. And that now is back down to 125,140, which is a slightly random number. I'm sure there's a very good reason for that.
Someone showed me how they calculated that, but I must admit I didn't commit it to memory. There is a calculation that gets to that number, but it's kind of tedious, and so again, it just looks like another crazy number, like others will probably come up.
But let's call it 125 and change. So
let's call it 125. Yeah.
What do you think? What are your thoughts around this?
Well, this is one of those areas, and there's another one we'll talk about, related to pensions, where this whole idea of phasing out the personal allowance creates this perverse set of circumstances where people earning lower amounts are paying higher rates of tax than people are earning higher amounts in a given window. They call it the death window or something. The tax death window, or they've got a lot of names for it, but and it's really, I think, unnecessary. It's one of the things I was hoping they'd fix, is just get rid of these the tapering. It makes things very complicated, creates perverse incentives. But there is, in this window, where you start losing your personal allowance, £1 for every £2 of income. You are paying effectively 60% tax when you're stuck in that zone. So, one of the things we talk to people about is how, if you're negotiating your salary and it happens to be 125, 500 or something, you need to think about that, or 150,000, you need to be thinking about that. And what can you do to sort of keep out of that zone? And there's a couple of things you can do. the sort of things that we talk to clients about around pensions and VCTs and so forth.
Yep. Well, I think you're right. I think it makes, yet again, it makes, in terms of your income, there are only two ways you can decrease the tax paid on your income effectively. One is through pension contributions, great, but those are limited by your earnings, and that that kicks in at around 240,000 when that starts being limited. And the other is VCTs or EIS or SEIS or other of these tax efficient schemes. So it really kind of, again, it just shines a light on those particular schemes. I mean, pensions is the obvious one. But again, the calculation, we've had a number of people where we say, okay, without even knowing, they are up to their limits, up to their annual, in fact, they're through their annual allowance limits on their pensions. And it's very common for us to talk to our clients about, do you know you're through your limits? And they'll say, oh, no. And so, one of the things we help clients do is frankly draft an email to their payroll or HR or whoever to say, perhaps, given the contract, you are now actually penalizing me by paying me the full max pension contribution. Perhaps you can redirect some of that into my PAYE monthly income. And in many cases, that's worked, and it's worked well. Yeah. So it makes pensions even more important, and maximizing the pension contributions even more important. But also, VCTs continue to be really popular, and for very good reason. Because they offer, the VCTs offer that, yes, you get 30% tax relief on anything you put in. Yes, the money has to be locked up, effectively locked up for 5 years. Otherwise, you've got to pay back that tax relief. But the advantage of VCT is it's a pooled investment. So yes, it's small, growing British UK companies. So yes, technically higher risk, but you get a pooled investment. So you get one certificate for however many companies are invested in. Diversification is your friend there. Dividends are tax-free. Capital gains at the end of it are tax-free. And they just, and the number of VCT providers, interestingly, over the last 10 years have actually dropped a lot. So the quality of VCTs out there at the moment is very high. So I would think that if anyone is, certainly for these higher earners, people who are paying 45% tax and above, certainly considering a VCT or looking at VCTs is certainly a really viable option.
Yeah. It is funny that you sort of, going back to pensions and people going through the limits, you'd think that would be something that wouldn't be possible, but because some, payroll departments, the companies only have certain information, you could be making employer contributions that they're aware of, or you may have instructed employee ones or matching and all that sort of stuff. But they don't necessarily have full information about your earnings, for example. They don't know if you're getting dividends from somewhere or something else that comes into the adjusted income calculation. So it's very hard to keep on top of that, particularly if you're busy doing a job, and HR aren't going to have all the answers. You're going to need an advisor to coordinate that information. So, that's whether it's your person, your tax advisor, your financial advisor, but to VCTs, we tend to focus on them because we like the pool investment nature of them, and there's some really good quality providers out there. But there are other options down the EIS and SEIS route if people are interested. Different risk profiles. Some people like to invest in really small startup companies, and you can get even more tax relief at that level. Interestingly, with SEIS, you also get if you make an investment that goes bad, you can actually claim the loss as a tax deduction as well. So the government is underwriting a lot of investment in those areas, which is good. So, it's not all bad. There are these ways of utilising some of that money, but it does seem like you sort of, instead of paying it to the government, you're paying it to something the government's incentivising you. It still feels like a long way of getting there, but these things are available, and they're worth discussing because, in the context of an overall portfolio, the risk if it's understood, is not as high as perhaps if you look at one of these products just on the face of it and say, well, hold on, this is a VCT, that's a risky investment. Well, yeah, it is, but let's look at this in the whole.
And
the investment's underwritten from the start because the government's paying for some of it. So certainly worth considering in the whole.
And the sums involved generally that, in terms of advising on VCTs, the sums that we recommend of allocation to things like VCTs are much, much smaller than the core recommendations around ISAs and pensions and things like that. They're very much periphery type investments. The one thing I just actually want to go to backwards for a step was around this, filling up your annual allowance and HR and payroll not having the full information. So people are inadvertently being over their limits. The only way if you are over your limit, the only way you find out from that is basically you get a letter from HMRC telling you you're over your limit with a bill that you need to pay. And that bill is effectively the tax relief that you've been given on your extra contributions for that year that you shouldn't have been given. Now, this can really actually be a double whammy sometimes because, all right, yeah, that's annoying. And however, in a lot of cases, you can ask your current pension scheme to pay that bill on your behalf. Now, that's the best way to do it because it means it comes out of your pension, so it comes out gross. It's just paying back the tax relief you've been given inadvertently, so it's not really a cost in a way. However, the problem is that not every pension scheme does that. And there are some pension schemes that don't allow or will not pay your bill. So if you're in one of those pension schemes, and by the way, you never know until you need to ask because they don't tell you, no one tells you it. It's not advertised anywhere. But the worst case scenario is you have to pay that annual allowance charge back out of net savings, out of cash. And that's the worst possible situation you could be in because then you've got to just write HMRC a check for inadvertently over contributing into your pension, and you're paying from net tax or from net cash as opposed to from your pension. So something really to watch out for. Right, moving on. What should we talk about next? Let's go with the CGT cut. Now, this is where capital gains tax allowance, which is currently 12,300, will be cut to 6,000 from next April, and then from 3,000 by April 2024. Thoughts?
Yes, I guess one of the things that we do with a lot of clients is to, on an annual basis, we have a general investment account, which is a taxed account, and then they have their ISA accounts, and so we're making a bed in ISA transfer. We're transferring money out of a GIA across into an ISA account, where there's potential capital gains. They normally arise in the taxed account, obviously. So anything you do in that account, you have to be careful of. So whether it is taking some money out where previously you'd get relief on the first 12,300. That's obviously going down to 6 and then 3. So anything that comes out of that GIA account, you need to be wary of. That can be tricky as well because capital gains tax is commingled. It's not like where it's a straightforward, you need to know your earnings for the year and to determine what rate that you're paying and all this sort of stuff. So again, not a straightforward exercise necessarily to calculate what the capital gains is on a given transaction up front. So you need to be getting advice around it.
What do you mean? Just define commingled? I know what you mean, but explain.
So you can't, for example, look at a transaction in isolation and say, I'm going to sell a portion of my investment in my general account, my taxed account, and it's going to have a capital gain of, let's say, 10,000 in total. Previously, that would have been fine because it'd be under the 12,300 limit. That's now going to attract at least the attention of a requirement for a calculation because we've only got 6,000 now. So then there's £4,000 left. Now, in determining how much tax we pay on that, we need to know more than just that you've had a 4,000 gain. We need to know what's going on with the rest of your finances and your taxable income in that given year.
Yeah. Okay. And then the other, I think one of the biggest impacts for this is going to be the old buy-to-let sector. Because again, this is where, people are paying a higher rate of CGT anyway. Let's say they're paying at the higher level, they're paying 28% as opposed to 20%.
Yes.
At the same time, in the last few years, they haven't been able to claim all the mortgage expense, because all the interest expense from your mortgage, because you can only claim up to a certain level on that. So that's become more of a penalty. You've already got the extra 3% stamp duty as owning a second property. So that's a penalty for you. And now this is a double whammy. And so I looked at this in terms of the difference between, for a jointly owned, let's say a couple who own an investment property somewhere, the difference here is effectively, it comes down to between, if they're selling now versus selling in 2024, post-April 2024, the difference comes down to, it works out about £5,000 in profit is effectively being reduced. That's, that hurts. That hurts. And that's, yes, all right, if you've got £1 million property, it's annoying. But if you've got on a £200,000, £300,000 property, that's fairly significant.
Absolutely. And that's the nature of these taxes, where we're talking about moving allowances around. We're not actually increasing tax rates, we're just moving allowances around. And so therefore, it is trickier to understand. It does require that bit more work to get your head around, what actually the allowances are. And you need to be taking advantages of any allowances you can get to make sure that you're not overpaying tax.
Yeah. All right, well, let's move on to the next one. So this one is an interesting one, because it's the classic bracket creep, which is inheritance tax. So the inheritance tax nil rate band threshold stays at £325,000, which it has been, I think, since 2006 at £325,000 per person.
Yeah.
And they've extended this for another 2 years. It was going at this till 2026. This has now been extended 2 years to 2028. So what's that? Another 6 years from now. Talk to me about this.
Well, you're talking about asset prices, and so with inflation, asset prices are going to go up, but the allowance isn't going up. So therefore, you're getting taxed as the assets go up in value. The amount that's susceptible is not quite the right word, are potentially taxable or subject to inheritance tax are going up considerably. And there's an article today I saw, inheritance tax takings are up $500 million in the current year or something. So it is going to become increasingly, for people who have managed to buy a house somewhere, so if they've kept that rate steady for 20 years, that's a massive increase to the tax take, because over the 20-year period, the assets would have doubled at least, let's say twice, particularly with inflation, heading around 10%. It's a bit lower before. So inheritance tax is tricky. There are a number of things that you can do quite legally, quite legitimately, to reduce the amount of assets in an estate that are chargeable to inheritance tax. And some of those are straight out reliefs, as around gifting and things like that, if done properly. And I want to emphasize the record keeping is essential around that sort of thing. Most people have heard of the 7-year rule when they think about inheritance tax, but there is, there are things you can do that take time to come into effect. And they do taper a little bit, back to tapering, but they do taper a bit towards the back end of that 7 years. So forward thinking. But there's also there are also other planning opportunities around inheritance tax, and they range in complexity and cost. But business property relief, AMIs are the two that I'm advising clients on at the moment, but there are others in terms of there's certain trusts and things you can use around that.
Yeah, and inheritance tax is one of those rather bizarre taxes, which seems that there are many legal, almost encouraged ways that people can structure their affairs to reduce it. And then it seems slightly bizarre that it says, like, we have this tax, but then we have this many ways, totally justified legal ways to get around this tax. And we kind of have these two camps. So for a significant, the significant payers of this tax tend to be the ones who either A, don't know about the different options available, or B, can't be bothered looking into it, or C, actually just want to pay the tax in the first place. So it does seem it's always been a slightly odd tax in that regard. And it does hit property more than anything in terms of the tax being taken. It does tend to, because if, as people come into their end of life, they've got their pensions, they've got some assets, and they've got property. And normally for a lot of people, property makes up the bulk of their asset on their death. Again, it just penalizes that, if as a holder of property in that regard.
Yeah, I mean, I think anyone who lives in London who has a house is almost guaranteed to be susceptible to inheritance tax.
Yeah.
They did introduce the residential property relief, 175,000 per person around residential property, but that's again subject to that horrible word tapering, which means it can go away once your overall estate is over a fairly healthy £2 million. But again, it's just more complexity around how do you make sure that you actually get to use that relief. And there's also planning around, if it's a couple who own a house and one passes away, yes, that relief passes to the other once the property moves across, but then how that gets maintained, and do you look at trusts and things which are available? They're expensive and they're slightly complicated, but they are available to mitigate the tax. So again, I agree with you entirely. It's a bit weird that you have this big headline tax. I'm sure that that's almost part of the marketing of it. We're taxing the rich this massive amount, but we don't talk about all the ways of mitigating it. It's a bit it's a bit weird. But
and it's something where I think it's yes, this is relevant. I guess if inheritance tax feels like an issue, especially when you think, if anyone's listening to this in terms of not necessarily them, but maybe their parents, it's definitely, and for most people, and within families, sometimes that money conversation can be tricky. So I would encourage, at least if you're in that situation, if you have older parents or parents where you're just not sure about what their plans are, if they've got plans, just try and start the conversation. You don't have to direct the conversation a certain way. People generally will have their own internal ideas in terms of what they want to do, but just starting the conversation to learn about, okay, just so to give people as much information as possible, that's where I would start with, just, because you never know. Lots of people end up in that situation and go, oh, I didn't know I could do this. I didn't know I could do that. No, of course I want to maximize the amount that comes down to the next generation. But if you run out of time, then you just run out of time and it doesn't work.
And most of unlike some other types of deductions, most of the ways of mitigating, even legally and so forth, require action and record keeping. It's not, and for someone who's not sure of themselves in this area, some guidance can be really valuable around that, and just some assistance around all the record keeping and figuring out what to do, and coming up with a plan for how to step through that over time. Can really help, even if it's figuring out what the time frames might be and all that sort of stuff. We do that sort of stuff with clients, cash flow planning and stuff, so you can actually see what it looks like when you're gifting this amount a month or whatever it is. Can be really helpful. So
no, it's a good point, and actually brings us on to kind of the final point I wanted to discuss today, which was the increase in the state pension. So the triple lock was confirmed, and now in April next year, the state pension will rise 10.1%. It's a big number. And for anyone who's got a full state pension, that full state pension now should be around £10,600. That's a lot. That's a big jump.
Yes. It's a lot for the country's finances to bear. But if you're someone who's, it depends a little bit on, retirement these days is a longer game than it used to be.
Yeah.
And if you're to use inverted commas or air commas around, a young retiree, notwithstanding state pension doesn't kick into your late 60s, but a lot of people still got a lot of life to live at that point, and so they might need that to support themselves in an inflationary environment. But there will be other people who are more fully retired, shall we say, who that's almost like a well, not quite a windfall gain, but it certainly would, they'd have potentially money that they could be looking to do something with rather than needing it to survive. So there's discussions around how to think about that open up.
Well, I think, one of the interesting things that we've talked about before is the idea of gifts of income. So if gifts of surplus income. So if elderly people can prove that effectively any regular gift they are making does not significantly reduce or does not reduce their standard of living, i.e. it's surplus income, that any of those gifts don't have are not applicable for the 7-year rule. So, the idea of who this benefits is potentially the pensioners who are on the wealthier side, where frankly they have their assets set up and they have enough money for the rest of their lives, and that's all great. Now they're all getting a little bit more of a pay rise from the state pension. And so an idea for here could be, well, potentially look at gifting this jump that we've had down to the next generation. And that next generation, it could be either through helping on school fees, it could be regular gifts, it could be helping with rent, it could be all of this stuff.
Paying the energy bills.
Paying the energy bills. But it doesn't even have to be the next generation. It could be the grandparent. It could be the grandparents paying grandchild's university rent or something like that. There are many different ways of structuring that, but again, as you've pointed out a couple of times, the key to all of this is just simply the documentation and making sure that if you've got a plan and if you're doing something, write it down, almost have it and write it down, even if you're just writing on a piece of paper, and sign the piece of paper and scan it with a date stamp or something to be able to prove that, again, in the unlikely reality that you ever will be investigated. However, there is always a chance. And for the sake of 5 minutes work of writing something down on a piece of paper and scanning it, it can save you considerable time, effort, and energy if there was ever an HMRC investigation.
Well, it's those who come. It's kind of being thoughtful for those who come after you, because if it's your time to move on and you've left everything neatly tied up with a bow around it, and here's the name of our advisor, and they've got a copy of all this, but here's a version. You can go with, they've got a lot on their mind already. So, having to deal with the hassle of trying to prove which gifts were and weren't subject to what rules and on what dates, I think is not something you really want to be doing. You want it to be tied up and sorted so that you're being considerate of those who come after you, I think.
Yep. No, I think it makes a lot of sense.
Yep.
Excellent. Well, that, I think, brings us up to the end. Look, really, thank you, everybody, for watching, and I hope you found that interesting. If you've got any specific questions about how any of these changes relates to your situation, please reach out and we can have a chat and see if we can offer some advice for your situation. But thanks, Adrian. Thanks for your time.
Thanks, everyone.
Catch you soon. Bye.